Major averages all in the red across the board. The Dow Jones Industrial Average down more than 600 points, 674 points to be exact right now, 2.2% in decline. The S&P 500, you're seeing that lower here about 17 minutes into trading, down by about 2.5%, 94 points there. And the NASDAQ Composite, deep declines there by about 2.5%, 282 points in the red. We mentioned the S&P 500 a second ago. Only two names look to be in positive territory. One of them, interestingly, is Twitter on the day. Speaking of tech stocks are continuing to get battered amid the broader market sell-off, with tech giants like Meta, Alphabet, and Netflix all down significantly year to date. Cowen senior analyst John Blackledge joins us now to discuss here. And we had seen some of these tech stocks moving in lockstep, particularly with what the Fed was signaling. And so now that the Fed has made their decision yesterday and kind of telegraphed what the pathway forward may look like, how do you expect tech to continue to react from here?
Yeah, I know, and thanks for having me on. We had a couple notes. It's interesting. We had a couple notes out this morning on Alphabet and Meta. We did just mid-quarter ad checks, right? With all the macro headwinds, rates and inflation, geopolitical. We're just curious. We checked with our agency that we use, our digital ad agency, to see what, where we were for Meta and Alphabet 2Q to date through May. It was interesting for Meta. Our agency saw ad spend down about 4% through May. We have for the full quarter plus 2%. So it's tracking below where we are for the full quarter. But remember last year, the iOS 14.5 changes started in 2Q21. So the comps actually get easier for Meta as we get through the quarter. So probably our numbers probably still okay. On the go forward, it's a bigger question. And the question will be about ad demand with the rising rates and all the macro headwinds. And we'll try to examine that as we get through the back half of this year and into next year. And then for Google search, our agency check was 18% growth. Through May, we're at 16% for the full quarter. So, kind of tracking relatively in line with where we are. And it's a little bit of a decel from the first quarter growth rate. So, it seemed, despite everything that's going on, the numbers for the two companies seem to be tracking, the near-term numbers seem to be tracking kind of where we are.
Hey, John, it's Julie here. Is there, though, when you're looking at that ad spend, is there a direct correlation between higher rates and a slowdown in ad spend? I mean, and a direct correlation through several layers, right? If higher rates are affecting, consumer spending on the margin, and then that affects these corporations, and then that affects what they're spending on ads. Do you expect to see a more severe feed through as rates continue to move up?
Yeah, there historically for advertising, there's a direct correlation with GDP growth. So to the extent that the higher rates lead to, kind of slowing GDP or declines, people are calling for a recession at some point, maybe back half of this year and the next year. And so if you look at, I think the thing that matters is what is earnings next year for these companies. Are the rising rates and the macro headwinds, are they factored into stock prices right now? If you look at, just take Alphabet. In the 08-09 recession, they obviously see the demand dwindling during that time period, and they put the brakes on cost growth. In 09, their cost growth was 0%, and their earnings were kind of in line with 08 levels. And as 08 was getting into 09, you saw the cost growth slowing down and then just flat in 09. So I think, for these companies, and you also saw in 2020, when COVID hit, both Alphabet and Facebook wasn't public in the 08 recession, their cost growth really, they put the brakes on costs. So that's what we're kind of going to be looking for. And they're going to see slower demand before any of us see it. And then I think they'll act on that. And even for Meta, they're losing a lot with their metaverse investments. And you're seeing reports since they report at 1Q that, kind of they're slowing hiring. So we'll have to see. But in the near term, it looks like things are kind of where we think they should be. But obviously there's interest rates and all of the headwinds are clearly going to be around for a bit. And so we'll try to do the best we can to forecast, kind of through the year and into next year.
John, how bad does it get for Netflix in a recession?
It's interesting. We did a ton of work on their potential ad business that we published that yesterday. I would say what's interesting is we think they're going to introduce an ad tier. Our work, and we do a lot of survey work, monthly proprietary survey work at Cowen, and our work suggested that if they introduce a new lower price ad tier, they could add up to 4 million new members in 2023. And we think they're going to introduce the ad tier sometime late this year, fourth quarter. And so 18% of people, of non-member respondents, said that they were either extremely likely or somewhat likely to sign up for a new lower priced ad tier. What does that mean? Well, it means from a revenue perspective, we get to about $900 million in incremental revenue from those members. And how, what does that look like? Well, we get to about $17 in revenue per member per month for a new ad tier. And that's broken into a $6.99 subscription fee, which is kind of around where other premium streaming platforms are. It's also 30% below Netflix's basic tier, which is its lowest price tier. And then we got to about $10 a month on the ad side. But to the question, if they offer a new ad tier, it's going to be cheaper, either for new members or if existing members want to switch. For instance, we also asked the question to existing members, would you switch to a lower price ad tier? And 41% said that they would switch. And you guys probably know that Netflix currently has 3 tiers, the basic at $9.99, the standard at $15.49, premium at $19.99. And half of the basic members and 40% of the standard and premium members said that they would switch. So if they do switch, and what was interesting about the basic members switching, the $9.99, they're paying $9.99. They would feel good. Yeah. Going to $6.99.
But right? John, let me ask this, because isn't it a big longer term risk for Netflix if you have people switching from higher price tiers just to these lower price tiers? Doesn't that over time bring their margins down? Does it hurt their cash flow?
No, that was the whole thing with our work yesterday. Just take the switchers, for instance, which we were curious about. I think it's a great question. We think they're going to generate about $17 per member per month for an ad tier. The blended ARPU for the company was about $15 in US and Canada in 1Q. So net it's going to be incremental. And we're after we did the work, we were talking about it, saying they probably should have done this sooner. So no, I think it'll be net incremental, and that's what we called out yesterday. It is a positive multi-year revenue opportunity for the company.
John, always good to catch up with you, and especially right now, given what we have been seeing in technology. Stay strong, man. John Blackledge, good to see you.
Thank you.